A reader told me he found my recent video on why I avoided EC World Real Estate Investment Trust to be very enlightening. Looking at the fairly good response to the video on YouTube, I decided to remind myself of why I avoided investing in another trust listed in Singapore. On October 24, 2019, a reader left the following comment for me. Eagle Hospitality Trust. The yield is almost 10% now. When trading halt is lifted, price is likely to crash, and yield will shoot up above 10%. Do you think the risk is worth taking? Thanks. Okay. What to say to this? In reply, I said that the risk looked pretty significant. I felt that I shouldn't take on too much risk in my retirement. Basically, that meant I wasn't going to invest in Eagle Hospitality Trust. The following day, on October 25, 2019, Eagle Hospitality Trust's unit price crashed from 64 cents to 54 cents. Of course, it did not stop there as it further plunged spectacularly to 44 cents on November 5, 2019. Eagle Hospitality Trust initial public offer was priced at 78 cents per unit. When even substantial shareholders cut their losses, it was rather ominous. In fact, it was because of substantial shareholders selling a substantial portion of their stakes that created massive selling pressure, leading to the catastrophic crash in Eagle Hospitality Trust's unit price. When elephants stampede, it is the grass that suffers. As retail investors, keeping an eye on what insiders do is usually a very good idea. When insiders buy, it is usually because they think they are getting a good deal. When insiders sell, it might not be because they think they got a bad deal. To be fair, there could be many rather innocent reasons why they sell. However, I would say that this is probably true when the stock is doing relatively well. Insiders might want to take some profit off the table. After all, it is never wrong to take profit, as the saying goes. Even if they don't buy more, they should be holding on to their investments. They should not be selling. This kind of selling by insiders is ominous. It was enough to stop me from investing in Eagle Hospitality Trust. Why were the insiders willing to sell at such low prices? The answer was probably in financial engineering. How realistic were the valuations of their assets? Making an investment decision based on published valuations could be a risky idea, as the valuation could be inflated. Longtime readers of my blog would remember that I said the valuation of Sizen REIT was too low. Why did I say that? They were able to sell their properties at a premium to valuations in the open market. If Eagle Hospitality Trust had tried to sell their hotels in the USA, could they get buyers to pay prices equal to the valuations provided? I rather doubt it. When Ascendus Hospitality Trust had its IPO many years ago, I wasn't interested in it because of financial engineering involved to make it more attractive. So, how did Ascendus Hospitality Trust become one of my largest investments at one point? It was only after some time, when the effects of financial engineering lapsed, and when the unit price declined to a level that became more compelling, that I bought. As an investor, I need clarity. When I analyze stocks, I am aware that I do not have the resources to do complete analyses. Most, if not all, of my analyses are incomplete, and I make decisions based on such incomplete analyses. I just have to decide on which bits of information are more crucial to my decision-making process. If I have access to those bits of more crucial information, I will be able to make a decision. It is almost like a jigsaw puzzle. We don't usually need to put every piece of the puzzle in its place to see the picture. As retail investors, if we can be approximately right most of the time, we will probably do well enough in the long run. If AK can do it, so can you.